Okay, so we have two lectures basically on the Great Depression and how it really changed the role of the federal government. You want to think, typically we divide what the federal government does into two categories: monetary policy and fiscal policy. The Great Depression radically altered what the government did in both those arenas. So in this lecture, we're going to tackle the monetary side of that. All right. So the Great Depression, if you don't know, was this prolonged economic downturn in the 1930s. Starts in 1929, but it really takes place during the entire 1930s. There's some recovery, but generally this is just a period of economic hardship that we refer to as the Great Depression. So here is GDP, real GDP, and you can see the decline here. Here we have it just a slightly different look at with the trend line put in here, and so we can see basically the U.S. is growing. It's growing along. It basically gets knocked off trend in 1929, goes down here and doesn't really get back onto that trend until after World War II. Here we have the Great Recession up here, which you can sort of see us getting knocked off trend up there too. But that's outside the scope of this lecture. All right, so that is the Great Depression. We also have the other macroeconomic indicator we care about is the unemployment rate. We also have an explosion in the unemployment rate going up to 25%, which is, I believe it's still an all-time high, although I'm not quite sure what it reached during the pandemic. But that is very high unemployment. Now what happens, interestingly enough, is the other thing that happens is deflation. Now this is very important to understand what's going on here. So our big macroeconomic indicators are GDP, of course, which measures the size of the economy; unemployment, which measures how many people are unemployed as a percentage of the labor force; and then we have inflation and deflation, and that's what's going on with prices. If prices are going up, we call that inflation. If prices are going down, we call that deflation. Now, a little bit of either one isn't necessarily a bad thing. You can survive that as an economy. In fact, we typically have about 2% inflation each year, and it's expected, and in many ways kind of actually good to have just a little bit of inflation. But in the Depression, prices plummet, and that is actually really bad. And we'll talk about that in a second. But that's basically, if we're just taking the macro picture, that's what's going on. We got massive unemployment, economy's in a tailspin, and the price level is dropping. And this is, of course, a really famous period in U.S. history. We have like famous photographs like this one, which kind of captures the distress of that era. Although this photo was pretty staged, you can go on YouTube and see the history of this photo. But the U.S. did recover from the Great Depression, as did the subject of this photograph. Here she is, 70 years later. Her family survived and even thrived. So it was like this horrible period in economic terms, but the economy did recover. Okay, and essentially, if we're looking at GDP is a function of all the spending: consumer spending, business spending, government spending. And so really the biggest component of GDP is consumer spending, and we have this rather large drop in consumer spending. So that's really what is driving the Great Depression. So why did consumers stop spending? What happened? Essentially, you could think about this as consumers stop spending, and also producers are stopping producing. That's what's causing this contraction in the economy. And so essentially, we have a lot of different things going on that all start with the stock market crash. So the stock market crashes, and this kind of has this ripple effect on the economy. You want to think about it was a bubble. And so periodically we get these bubbles where, essentially the price of something does not reflect its value. And then people realize this, and the bubble pops. And this usually leads to an economic downturn that is usually short-lived, but it was long-lived during the Great Depression, and we'll cover why it was so long-lived later. And so we get this bubble popping, and then this has all these domino effects. We get this decline in wealth, we get deflation, we get uncertainty, and then we also get failures of several banks. All right, so here's the stock market crash. We can see that that plummet. As I mentioned, it's basically a bubble. We have this very, very famous quote from Irving Fisher, a prominent economist at the time, who you'll learn about next week. Next week's reading is about Irving Fisher, where he says, right before the bubble bursts, stock prices have reached a permanent high. Whoops, Irving. And we actually, prior to the stock market crash, we had agricultural issues. Okay, and so the stock market crash is going to have a direct effect. It's going to have an immediate effect on people who have money in the stock market. They are going to lose their wealth. They're going to lose that money that's tied up there, or at least the value of their stocks will decline precipitously. But in this time period, very few Americans actually have money in the stock market, only 16%. So the direct effect of this wealth loss is minimal. And also, you would think these are usually rather well-off individuals, so they can weather this downturn in their stock in the stock prices. And so that direct effect of the stock market crash is not necessarily a big deal. Now, what happens though is when the stock prices drop, then we have kind of an overall drop in prices in the rest of the economy. That's deflation. And this is really bad for households. And this is a little bit in the weeds, but it's important. So basically what is happening is here we have a balance sheet for households. And so this is their liabilities. This is the money they owe. So this is going to be mortgages. This is like essentially what people owe on their house. And so what you can see is the amount they owe on their house between 1929 and 1930 on average goes up by 20%. So it's as if the money you owe on your house went up by 20% all of a sudden. So how did that happen? Like, did they take out bigger loans? Like, what's going on? How could all of a sudden they owe so much more on their house? And the answer is that deflation. And so essentially all the prices go down, including your wages. So all of a sudden, wage is the price of labor. So the money that you're making goes down, but the money you owe on the house stays the same. And so in essence, in real terms, the money you owe has gone up because everyone's making less. All other prices have gone down. The price of food's gone down, the price of cars have gone down, but the price you owe on your house hasn't gone down. Your wages have gone down. So in real terms, once we adjust for this deflation, you owe a lot more. So that's what's happening here, is everyone's wages are going down. So this is in real terms. The money they owe on their home, even though in nominal terms, it's the same, but in real terms, since they're making less, it's all of a sudden much more burdensome. Now, the way mortgages worked back then made this even worse. So nowadays, you get a mortgage, typically 30 years, and you pay it off each month, and then at the end of the 30 years, it's paid off. You're done. That's not how they worked back in the 1920s. You got a mortgage, it was typically for 5 years. And at the end of the 5 years, you still owed money. It was called a bullet payment. So you still owe the bank a bunch of money. So basically, you would go to the bank at the end of the 5 years and say, hey, my mortgage is up. I know I owe you a bunch of money. Can I get another loan for that? And then basically you can pay the interest or like a little more than the interest. Basically, it was kind of like how credit cards work in the present, where you can pay the interest, you can pay a little more. But you're still going to have this lump sum payment at the end. So the economy crashes. People are owing a lot more money in real terms. For those people whose mortgages were up, remember the 5 years, so a lot of people had mortgages up in 1930. They go to the bank and they say, man, this is a lot of money now. My wages have gone down. I'm selling my crops for less. I can't afford this. I can't pay this bullet payment. Can you give me a loan to cover it for the next 5 years? The bank needs money. The economy is bad. They say, heck no, you owe us the money. Then we get a bunch of foreclosures. And so because of that deflation, that then triggers all these, because of that deflation in combination with how the mortgages worked back then, that triggers a bunch of foreclosures. All right. other thing that's going on is when the economy starts to tank, there's a lot of uncertainty about the future. And so typically what people do is they spend less. So they say, well, I don't know what's going on. Even if you got a job, even if everything's good, you say now's not the time to make big purchases, right? During the pandemic, everyone was like, I don't know if, I want to buy a car right now or I want to buy a house right now. Let's see what happens. And so those are the industries that are really affected right away during an economic downturn, is those big ticket items. And so we can see this reflected in the data. All right. So you can see the automobile registrations falling, department store sales are really kind of the first place we see this downturn. Of course, and this is going to trigger even more deflation. As people are buying less, prices are going to come down. And so we're going to kind of have this problem that's building on itself, this domino effect that all starts with the stock market. All right, bank panics. We'll get into that in a second. Let's take a break.